All righty, traders. This is Blake. You are listening to the Lunch Money Show. Hope everybody's having a great day. And whoa, wow, we got a breakout, didn't we? Man, who would have thunk? Who would have thunk we would have got a breakout today? Well, the thing is, you can see the Nasdaq here breaking higher. If you just, using trading analytics, you probably just got the update just a moment ago regarding the breakout in the Nasdaq 100. But that isn't even at all-time highs. But the S&P, yeah, it is at all-time highs, and that pennant is breaking higher. We're trying to hold the breakout right now. I mean, we've seen a little bit of selling coming in, but what's interesting is, we are basically holding the breakout for right now. I mean, that's my fault. I didn't mean to do that. But you guys can see, as we come across here, it's at new all-time highs. If you look at the Russell 2000, the Russell 2000 also has like a intraday cup and handle that, should challenge channel resistance. Channel resistance is not very far away, but from a measuring point of view, and as I say measuring point of view, because what you do is you take the bottom of the cup to the top. It's a resumption of trend, and the Russell 2000 is hitting new highs. So I mean, that's not out of the ordinary when you see a cup and handle pattern, but it's logical. It's very interesting. Like today, you think it's a resumption of what we saw last Tuesday. So last Tuesday we saw the rally into new highs, and then now today it's just kind of that push higher. Now there are markets that are underperforming. Obviously, you could take a look at the Dow. And you look at stocks like Cisco, it's going to weigh on the markets a little bit, and Cisco had a big reversal. I had a conversation about Cisco earlier today. I want to go ahead and say it again for those of you that had missed it. And I think it's important because of what we're seeing. Now, some of you weren't on the Face show this morning, so that's totally fine. That's why I wanted to say this, because I do think it's an important topic of conversation. So if you look back at Cisco's move back in the 90s, and for those of you that don't remember back then, or you weren't trading back then, you'll notice that this was the low in 98 to the top right at the dot-com bubble, so right in 2000. That if you look at that as AB, the equal leg move is where we're currently at right now. So you have AB equals CD. That is an equal leg move, which also matches the 161% extension of the fall. All right, so that's the fall from when we peaked in 2000 to the lows, which I guess is 90 or 2002, excuse me, the lows in 2002. So after the dot-com crash, we have reached the 161% extension. Can you guys see that? 161% extension of the dot-com crash. That's where we've stopped. Now, we didn't stop here today. We've been up here for the last several months. It's something that we did talk about a couple of months ago. I don't know if we talked about it on this show specifically, but I've talked about it several times because I drew out the charts a long time ago, and I remember having this conversation. What's really interesting, though, about the price action today is something that I want you guys to be thinking about as we go into the third quarter and fourth quarter. Because right now it's summertime. I mean, it's summertime, volatility is low. The markets are just looking for excuses to rally, looking for excuses to continue to press higher, and we're getting them, right? What's the excuse today? The excuse was, oh, PPI came out weaker than expected. Interest rate expectations have dropped dramatically. Whoop, time to go up. And I mean, logical, yes. Understandable, I get it. I guess. Any reason to stand in the way? Nope. It's summertime. Yep. Volumes are down. Yep. Liquidity is poor. Yep. The invisible hand of the market still pushing because there's unlimited passive flows coming in the market. Yep. Do I want to get in the way? Nope. All right. So let's let the market go. So that's what's happening. You're seeing the market just plow higher. Interest rate expectations have come down. Yada, yada, yada. Great. But you take stocks like Cisco, and this price action is really surprising to me, kind of, but more importantly, it's what has happened in the market and why. So the big question that's on everybody's mind, and it's the thing that everybody thinks about, the AI build out. Are we going to be able to live up to the hype? Are we going to be all this money that's being spent and all the future commitments of money that's being spent? Is it actually going to get spent? Is somebody going to pull out? Is Wall Street worried about, overspending? Because some people, believe it or not, that are on trade desks, like I traded in the dot-com bubble, but I was also 26, 27 years old. A lot of the traders that were 26, 27 years old at that time, that's my age. So I'm in my mid 50s, guys, just so you know. I turned 54 in about a week and a half. All right, so I'm going to be 54 years old. People that are my age are leading the trading desks at Goldman Sachs, Citigroup, probably even guys and gals that might even be younger than me, right? So you got all these traders, but if they're 20, they were 26 or 27 in the 1990s, they were probably at Harvard or Yale. They were getting their master's degree, maybe their PhDs for the next couple of years, and really didn't trade through the dot-com bubble. They remember it, but they weren't trading it. But what I know and what I remember near the top of the dot-com bubble is that when people started thinking about, like, okay, all this, all the, none of these companies make money. WorldCom's laying down all this fiber. You got Earthlink and Mindspring and all these companies that are doing, everybody's trying to get fiber everywhere and do internet connectivity everywhere to homes and blah 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 blah. The idea that there'd be an infinite amount of money and returns were gonna just continue flowing is the same comments that we get today. And this is I'm going to go to our chat room, guys. This is our chat room here. And this is a comment that came in a little bit earlier from AJ. AJ might even actually be listening in right now. AJ listens into most shows, but he says, where is the comment? Hold on. Talking about SanDisk. Oh, yeah, here it is. SanDisk. The company also expects to return 100% of excess cash to shareholders. And my comment was, yeah, if I remember correctly, back in the 2000s, that's the exact same shit I used to hear back in the 2000s. I remember sitting at my desk listening to, like, Joe Kernan and and Mark Haynes in the morning. Rest in peace, Mark. Sitting there in the mornings going, and I'm in my 20s, and I'm at our trading floor going, that doesn't make much sense, and that's the same kind of stuff that we hear today. And I'm not saying this is the top, but we're starting to see price action. And I'll go back to Cisco. This is the kind of price action that scares me. Cisco beat top, bottom end. Guidance is going through the roof. Cisco, as soon as the earnings came out, we rallied. We were up, like, we were at all-time highs. And then we have quickly given back those gains. Now we're down 10% on the day. Now the stock market is broadly ignoring it because of all the reasons that I just told you about 5 minutes ago. PPI came out, no one's getting in the way, still CapEx spending is still good. We're fine for now. But this is the type of price action that does worry me. And this is the kind of stuff, and I was just pointing out Cisco because we did complete the ABCD. We're at the 161% extension. We just did a false breakout, and it's not going to be this one stock alone that makes the difference. But when you see this quarter, And that's the point I was trying to make earlier on the Face show. We are seeing companies, as Chris pointed out yesterday, and I'll bring in Chris in just one second. You know, as Chris and I were talking about yesterday, hey, you know, over 80% of the companies that have reported earnings report great earnings, blowout earnings. But what we're seeing in price action in a lot of these stocks, unlike the last couple of quarters, we're now seeing stocks actually reverse, and they're starting to show some signs of weakness. Now you're getting rotation, which is great. Today's a perfect example. You got stocks rotating into, you know, broader base in the S&P. As I was just showing you guys, you know, S&P is at new all-time highs, right? No reason to stand in the way. Sounds good. You know, S&P, but not as big of a rally as we're seeing in the NASDAQ. So we're seeing rotation, you know, rotation in the NASDAQ. Then you got, okay, well, I'm going to rotate out of the Dow, which the Dow is down today for obvious reasons. Then you have people going, all right, great. I'm going to get into the Russell 2000 as we hit new highs, and we're going to channel resistance. That's healthy for the market to see this rotation. And you might say, well, you know, hey, out of the US and maybe into Japan. Yeah. And then you got the, well, not FTSE, sorry, here. You got the Nikkei breaking higher above its 618 retracement. It's actually popping higher, right? You would, again, if you go to trading analytics, you could go to the Nikkei, and you'd know that you know that is happening. This is not a sell everything. No, we're at all-time highs, but we're just seeing healthy rotation, and this can continue. But the point I wanted to make here with the Cisco, what happened in Cisco overnight, that is becoming a common theme, which I think is going to really, really come into focus the third and fourth quarter of this year. You know, we're just getting past earnings season. We got a couple months right now that we're going to, you know, all the traders are going to come back, but it's summertime today, middle of August. Liquidity is poor. No one wants to stand in the way. And you got Fed expectations, rate expectations coming down. Stocks are liking it. And you're going to continue to see that rotation. And you're going to continue to see us play musical chairs while the music is playing. But when the music stops, make sure you have your chair. Or in other words, be here on this show or be on one of our shows where we start looking at the technicals and saying, you know what, the market doesn't look good anymore. Right now, the market looks good. And it continues to look good. It's looked good all week. It's looked good for the last couple of weeks. And it continues to look good today. There's nothing jumping out other than Bitcoin crapping the bed right now. Don't know why, but you know, it does that periodically. And by the way, we're approaching really key support on Bitcoin. If you don't know where key support is, you just go over here to our bias chart and go, oh, well, you know, critical support in Bitcoin is at 62.2. That is correct. We are coming towards that support. And I have no idea why, other than it really hasn't performed well. But Bitcoin is maybe the outlier as we approach the support. But other than that, I mean, the markets look pretty damn good. You have emerging market currencies. Go look at the dollar mex. The dollar Mexican peso is at new yearly lows and has broken down out of a wedge. That means emerging market currencies are rallying against the dollar. That's called a carry trade, guys. Better carry trade than any yen pair you can find. Mexican peso, strong. As long as that stays strong, that means the undercurrent, what's happening below the market, is not really too worried. Currency guys and gals are like, yeah, I'll just continue to buy emerging market currencies because I'll carry a yield. Stocks are breaking out, healthy rotation. We're fine. And it's summer, volumes are low, stocks continue to press higher, we're okay. Until you see something shift underneath the surface, that's when we start to worry. And like I said, I'm glad you're here because by being here, you guys are going to be able to see what's below the surface because we talk about everything on this show. Right, Chris? We talk about
That's
everything,
right, dude.
everything. And make sure you guys stick around because we're going to have Jim Welsh from Macrotides. He's going to, you know, be covering what's happening around the markets as well. So, Chris, what do you make of this pop to new all-time highs?
Blake, I've got an interesting story to share with you this morning.
Does it have to do with golf?
Nothing with golf. I say that for after hours, dude. You know.
Okay. All right. All right. All right. What do you got? What do you
All
got?
right. I want to show you something this morning. So this is a live look at a little gamma profile. I'm just going to paint a quick picture here. So I look at this stuff every single morning. And today, when we came into the live market, I can actually go into this replay feature and show you exactly what I did see this morning. So I'll bring this back to I usually start my prep sessions like 8 a.m. Eastern time. So let's go back to 8 o'clock this morning. And this is what the gamma profile looked like. Now, what I read from this is live price SPX 500 or the CFDs trading at 7760. This is before the news, so PPI comes out at 8:30. My read on the day was we're probably going to see price stay below 7800 and see price stay above around 77. Well, I use these levels. So this level and this level is kind of my box for the day. So about 7700 on the low side and 7800 on the high side. That was all morning. Okay. Now at 9:30, can you see this giant purple line right here?
Yeah, it's purple. It's fuchsia. Sorry.
Okay. So this fuchsia line was not on here until 9:30 in the morning. What this is this is an opening bell reading of all option activity. And there was a crazy amount within the first minute of trading today. There was an excessive amount of out of the money call options that distorted the gamma profile this morning on SPX. So even though we had PPI 830, the markets were drifting a little bit higher. Here's around 845. Here we are at 63. We get into 9 o'clock. We're at 67. This is all pre-market. Now we're at 70. Right at the opening bell, I feel like there was some type of big mad rush in quants or algos or something that just distorted this with all out of the money call options. And this thing blistered higher. And once we were trading live, this literally this fuchsia line printed out of nowhere. And I have never seen this print be this off base or this distorted compared to what I was reading on the earlier prep for the day. And so point is for me, I saw that it gave me a little caution. I did a directional play, which usually I like to trade ranges on the indexes, but I did a reverse iron condor. So I make money if price goes up or down. I just want to see if this is distorted in any way, shape, or form. I can make money here, make money here. And so because price went up to like 78.16 or so, that paid very well. And I also had a pin price and a pin price that also paid very well. I grabbed a quick $300 a contract this morning. And now I'm waiting to see, is this good enough to say that right now in live market, return to live, do I have a good enough candidate to say that the 7,800 could be a good pin price this afternoon? It's possible, but I'm already up on the day. I feel like I'd be a bit more of a forcing if I force the trade today. I could throw in a pin trade. It's only 12:48, so there's still a few hours left to trade. But if it goes to retest the highs, that trade could be a loser. If it open or it closes where about we open today or we fill the gap, it could be a loser. So it's I don't think it's worth the risk of necessarily kind of throwing away my potential profit today just to get greedy and try to double down on some profits. Even though I will say this by the end of the day, if we're around 7,800, I wouldn't be surprised. I'll chalk that up as yep, just more evidence to say it's a good trade. But because I already had profits this morning, I'm not going to force it. So long story short is crazy amounts of early opening bell activity that distorted all option volume. And it was very speculative. I think this is that type of manipulation we talked about where it's dude, it's low liquid. It's lower liquidity than usual. It's highly speculative in the options world. This is the tail wagging the dog. This is what Monday, Tuesday did last week. This is what today did after literally 6 or 7 days of nothing, man. After that Tuesday rip, Wednesday, Thursday, Friday, Monday, Tuesday, Wednesday, today, there's little to no direction. Even today, because we gapped up, it's still barely moving. I mean, the markets from the opening bell to now, we've moved up about 23 points. The market was forecasting a plus or minus 32 on the day. We could still be efficient for the day, even though the market ripped up to fresh all-time highs. So
yeah.
Anyway, I mean, Blake, are we going to hit, freaking 8,000 before we have any decent pullback or dip? I mean, the bond market
seems that way.
It does kind of seem that way. It doesn't mean I want to get aggressively bullish here. It just means I wouldn't be surprised.
Yeah, I mean,
I did get filled on RSP. RSP, we talked about it yesterday. I got filled on that trade.
Oh, you did? Okay.
I did. That's good. So let me build that trade out. This was RSP. RSP chain. This one's out to next summer. So I went to June of 27. And I bought it's the 210 by 195. There's about a 94% chance of profit on the trade. Of course, it doesn't work. June, 210, 195. So 15 wide profit trap. Looks like this. Current price is 221. I have my profit trap in here. My break-even price is going to be around 178. Blake, that would allow me to handle about a, let me see what the correction would be. If my break-even price is, let me see exactly what this is at. I know I calculated this morning, so I'm probably up to bed here. Break-even price is 173. 173. So this trade filled. 173 gives me a break-even of that's a 22.4% correction that I can stomach. Not that I want to see that, but I also have a big fat profit trap. So my trade looks like this. There's no risk to the upside. I have a profit trap that kicks in around that 210 handle. So no risk here. Profit trap kicks in at 210, peaks at 190, and then it continues lower. And then I have, it's technically it's undefined risk, but that break-even price would be 173. That's my break-even. So going into whatever the rest of this year looks like, I mean, to have like no dips into the midterms, I find that to be really weird. If we have no pullback into midterms, I'd be way more shocked. I feel like that is heavily manipulated. Blake, what do you make of the markets making fresh all-time highs while the VIX goes up? You like that?
It's it doesn't really bother me a whole lot. I mean, volatility can mean a couple of different things, but yeah, if we're seeing higher volatility and it's relatively low, like right at these levels, it doesn't really concern me. It's the big, 10-15% spike up, and then I start to go, oh shoot, maybe I don't want to see that,
Right. Fair. So I mean, to me, since we did make a pretty convincing break above this 77.90 zone, it does look like a bit more of like you had the wedge drawn, which I think is also great. That wedge, where's that wedge measurement to you? Are you taking like this distance? Like this distance and projecting it higher? Like what's your symmetry play on this little breakout?
Oh, well, I'll show you. Okay, so let me this is some I'll give you this is basic technical analysis. This from hold on really quick. Don't go anywhere.
At least Blake has pants on.
I do. Actually, I've got to take my son to Lululemon today to get some khakis because he needs it for college. He leaves college tomorrow back for his sophomore year at Ole Miss. So this book right here, this is technical analysis of stock trends, right? This is the Bible. I've had this book since the 90s. If you ever want to read like the technical analysis, but mine's like the 8th edition. I think they're on like the 20 something edition or whatever. Just to answer your question, I learned from that book years ago, right? And the only way that I measure a flag is really quite simply, and here, let's go to a pennant, this pennant. There's a couple of different ways here. So, and here's how you do it. So I don't know, right? I don't know if the pennant is measured from here, or here. So there's like 3 potential, in my opinion, where we hit a fresh low. Because here, let me see if I can zoom in as close as I can so you guys can actually understand this concept really quick. See where we were trading and we had a fresh low. See how there was no fresh low there. I know I'm getting really into the weeds right now, but you see how there was a fresh low there, so that counts. That's possible. See how there was a fresh low there, that spike low, that counts. And then over here, since we broke there, that's a fresh low. You guys see that, right? And it's because some of you might say, well, why isn't the flag from here? Because there was no fresh low. Oops, here, let's delete this. Okay, so there's no fresh low there. So the flag is measured from here, or here. Now, when you're looking at a pennant or a flag, the pennant itself, the flag, the thing, this thing, right? That flag can't measure more than 50% of the entire length of the pole. So if this is the pole, this is, like, let's say this is about 45, I would say 45% of the 100% here, right? And if you go, well, this is the pole. If that was the flag, that might be close to like 60%. I don't know. I think it's a little extended. But then you might go, well, Blake, you're looking at it on a 4-hour chart. How about if you look on a daily chart? Yeah, daily chart's a little bit different. And that's why I'm like, you could argue that maybe the flag is from here. That was, a much shorter distance. It's less than 40% or less than 50%. So realistically, I think we go from here to here to here. I'm giving it the benefit of the doubt because you asked me like how far we can go. Well, if we take this flag, right, and then you go to the bottom of the flag where you just basically had your launch point. So if you go back to a 4-hour and you go, okay, well, the launch point was basically from here. That means the maximum that we could see is about 8,200. Now, I think that is a little aggressive. And I don't just sit there and go, oh, I'm going for 8,200, put my limit, and I'll see you guys in a couple of weeks. You guys have fun. I don't do that. I'll sit there and go, okay, an outsized target, if everything macro is working out, let's say interest rate expectations continue to go down. Let's say tomorrow retail sales come in weak. And everybody goes, oh, damn, the consumer can't keep up. Now, we always knew they're racking up consumer debt. They're cranking up their credit cards. They're getting themselves more in debt. Now consumer spending is dropping. Dude, there's no way the Fed's going to raise rates. Great. All right. So they can't raise rates. Stocks are going to go up. If we have stuff like that happening, I could go, all right, maybe we could see 8,200. But I'm going to get nervous because I do think that maybe a more realistic expectation is some like this move might take us only to 8,150 instead of 8,250. So I start to get nervous as we get a little higher because I have 3 different points I can measure the flag from.
Right.
And so, it has nothing to do, has zero to do with the pennant itself. The pennant is just the consolidation. I just want to make sure it's not more than 50% of the distance of the pole. As long as that's, I don't care about the distance at all. Have we been in situations where it does something like this? Like we do this, we only break out the distance of the pennant, and then we get a full-on reversal? Yes, I have seen that. Yep. Yes, I've been stuck in those trades. Yes, it's worked against me. But generally speaking, more times than not, 65, 70% of the time, when you have a pennant that looks like this, the measured move is more likely. And that's why I tend to, I'm a probabilities guy, as all of you that trade the markets should be. So because we're probability guys, we can look at something and say, all right, there's about a 65% chance that's going to work out. Is that 100%? No, it never is. But we can realistically say, based on my experience and experience of people 100 years before me, we can go, there's a good 65, 70% chance that works out. So as long as the idea of why things are moving, the macro picture, the jobs data, the inflation data, the comments we're getting, and we're not getting too much crazy crap coming from Iran, because we know that the Iran-US conflict's probably going to go on for the next 20 years anyway. As long as nothing crazy is happening, then I think the 65% chance sticks. And so basically, in a nutshell, that's how I figure it out. Whoa, that was a big education. See, you guys don't even need to buy this stupid $100 book anymore. You guys can just toss that. Just stick around here.
Just ask Blake. It's an Blake. AMA for Blake.
Yeah,
ask me anything.
There you go. All done. All right. So anyway, that's how I look at things, Chris. Hopefully that helps you guys out too.
I like it. So, I mean, yeah, path leads resistance for right now. Next week, OPEX. It's going to be interesting to see what the contract size is for next week, Friday. Usually what I do see is if VIX is down and stocks are up going into an OPEX, there usually is a pullback. Our 1 month implied correlation is also sub 8. So I'm just still bracing for like probably minimum like a 2 to 3% correction. It certainly could be a little bit more of that vulnerability window of whatever, dude, 5 or 10%. I mean, the average pullback for the year is 14%. We haven't seen it. We had 9.97%, 5%, 3+%. We haven't seen a 15% correction.
Jim's going to tell us when that 50% correction is coming in, aren't you, Jim?
Yes, well, I will.
Yep, we got. I mean, I'm seeing out there
today, but I'm not gonna. But it's coming.
I think we. I mean, I think we do have a secular bear market. When you put it pretty well, Blake, when you said the musical chairs stop. I think the scary part is how concentrated these gains are. That it'll unravel way faster than people think, and so it's just a matter of when. But it's like, this isn't the time to call a top. But my gosh, dude, we will see some crazy, awful, ridiculous movement to the downside when this market's ready to actually have a cleanse. So,
Chris, I'm going to ask you for a big favor.
Okay.
When you get a chance, well, actually, when Carter gets into, oh shit, I just accidentally did something. Sorry, guys. When you get a chance, and Carter gets into school,
okay.
Right? Can you tell me if they still do musical chairs? Because that was like, as a kid, that was like the funnest game that we used to play.
I mean, it was pretty violent when I was a kid.
Yeah, that's what made it fun.
You had to push people around, knock them over, kick the chairs out, pull off from underneath them. It was
almost as fun as Red Rover.
I got in a fight with Red Rover. That was my neighbor was like one of my best friends, and we fought like fisticuffs over Red Rover on the playground.
I can see like
do kids even have recess nowadays, man? Yeah.
I'm sorry.
I said, do kids even have recess anymore? I feel like that's terrible if they don't. I feel like they need to get that energy out somewhere.
Oh no, I mean, my kids are in college now, but last I remember they had recess.
I got in trouble for kicking we played kickball and I kicked it over the fence and it broke a teacher's windshield. I've gotten all sorts of playground trouble back in the day.
Chris Pulver, the menace. I love it.
That's right. All right, you guys
Chris,
have fun.
Thank you. Your nickname was Pulverize.
Right? That's right. Yeah. See ya.
We'll see you tomorrow, Chris.
All right, bye.
Mr. Jim Welsh of Macro Tides. Good to see you, my friend.
Likewise, Blake.
So, hey, we're at new all-time highs. What do you make of this craziness that we've got going on?
Well, my take has been for really a number of weeks that we were forming a triangle. My belief is that is a wave 4 from the lows we saw on July 29th, I think it is, and that we were going to get a thrust higher. And 7,700 to 7,800 was, like a guesstimate. And then you have to see how it unfolds. And this last week in the weekly technical review on Monday, my expectation was we were going to see the S&P move above the high we saw a handful of days ago at 77.93. But my take is that this is the end. Oh my God. Tune the doors up. The end.
This is it, huh? Like it's
this is wave 5, and potentially it's 5 waves up from the March 30th low. So the S&P's gone from, call it 6,300 to 7,800, just to make nice round numbers, 1,500 points. What's a 382 retracement of that? About 550 points or so. So I think we're on the doorstep of a 4 to 7% correction over the next, 1 to 2 months or so.
Okay, so I was just talking about the pennant that we've developed in the S&P, and I'm just looking up at my chart over here on the Nasdaq 100. We're nearing highs. Russell 2000s breaking out to new all-time highs. Is it possible that because it's such low volume, we were just talking about how rate expectations have dropped, and rate expectations have dropped to where people now believe that the Fed's not going to raise rates, due to the CPI and the PPI that came out today. And how about if retail sales come in weak tomorrow? Is it possible that the S&P reaches for 8,000 before it's all said and done?
Of course, it's possible. It is. I mean, the one thing I'm sorry I didn't include it in the chart deck for today, but in Monday's weekly technical review, what I went through, and I think you and I may have talked about this, that if you look at the number of stocks that go up as a ratio to how many stocks go down. And you compare the last 2 weeks to what happened off the March 30th low, it is so much weaker, Blake. So in terms of the S&P's made a great move. It looks like a vertical shot, which was expected.
Right.
But under the surface, this ratio of breadth has been really, really weak. And the analogy I use is if you throw a ball up at 50 miles an hour, yeah, it's going to continue to gain altitude for a window of time before rolling over and coming down. You throw it at 100 miles an hour, obviously the latent energy is going to last longer and carry it higher. Well, this rally, based on that indicator, is the 50-mile-an-hour toss. So when I look at this and the structure of the chart, my conclusion is in probability land that we're nearing a high and we're set up for a pullback. And then it's just going to come down to, is it a garden variety, or do we get some reasons to sell that causes the 7% correction or not?
Yeah. And Jim, that's a great point, actually. So we have one of our YouTube listeners, obviously Asian, because I can't read that. Zix. So Zix, I'm going to read this question. It says, you're all in a YouTube disaster scenario echo chamber feedback loop. So I think it was earlier when Chris is like, "Oh, you're going to be see a 50% correction."
Yeah.
Look, Zix. Let me just say, first of all, no, we've been focused on the stock market just rallying. The fact of the matter is, though, we are in a situation that maybe some of you have never seen before. Like I said, I'm in my 50s. I turned 54 in a week and a half. Jim is like 170 and he turns 172. Just kidding, Jim. Jim,
I don't go up by 1 year anymore. I go up by 2 years to the crack.
Jim's
been around born on leap year on February.
Jim's been around longer than me, but we've been trading for decades, and I've seen the song and dance before. The question is, how far do we go? And that's why I still think that 8,000 is possible, just because technically it looks possible. But I may be wrong, and maybe 6 months from now we look back, Jim, and we're like, wow, what's 200 spooze points amongst friends? When a top actually comes in. The thing is, we are dealing in unprecedented times with a lot of build out that reminds me and echoes a lot of the dot-com bubble, which I did trade through. And by the way, I benefited greatly through. That was what really kickstarted my career when I was in my mid-20s, and I was 27, 28 years old. It was like, how I made all my money was through the dot-com, trading through the dot-com bubble and then shorting the top. And so this is, since I've seen this song and dance before, and I know you have too, Jim, we don't talk in a doom loop. We look at the markets pretty constructively. And I could say that, hey, everything looks bullish right now, just as I've said for the last 30 minutes. But we have to know where, things get a little dicey. And right now, like the price action in Cisco overnight, that's dicey. That's the kind of stuff that you don't want to see when the markets are rallying. Right. But Jim, I'm going to shut myself up. I want to let you respond to Zix.
One thing I think,
go into your charts.
Okay, is time frames. I agree with Chris. There's a secular bear market that's going to happen. We've had like 3 or 4 of them going back the last 120 years. So it's not like we're talking about something that's never happened before. The most recent one was from 2000 to 2009. The S&P fell not once, but twice, 50%, 57%. And then 66 to 82, 16 years of chopping around, and it included a 50% plus decline. So these things happen, and the symptoms are people are really excited at these big clubs. They're very, very invested. So household investment in terms of the stock market is the highest it's ever been. All right. And the reason it gets that way is because there's a good story that tells everybody you got to be in. Well, guess what? At some point in time, the story changes. And the reality is most people don't see the change coming. And so from a time frame standpoint, Is there a secular bear market coming? Yes. Is it starting this week or next week? I don't think so. And so the time frame I'm talking about is, okay, the next, let's say 1 to 3 months. And I think to address the comment you're making, Blake, is could we see a 4 to 7% correction and then the move above 8,000? That would be my bet. So we get a pullback and then we have the opportunity for another thrust that takes the market higher.
Jim, I remember, I want to say after the financial crisis, the GFC, it was 2008, 2007, I guess, 7.5, 2008, when the S&P had lost 80% of its value. And I remember going
Well, that would
outside
be
of
the NASDAQ lost 80%.
yeah. But my retirement account, and I don't want to actually use the actual numbers.
Yeah.
But I remember going outside of my office in Plano, Texas, and we'd been acquired by the Wise Trade Group at that point in time, and it was I just started a chat room, like I just started our chat room that's in our current form, trading analytics, like in 2005. So I remember we were 2 years into this, and I remember going outside. It was brisk. It was like kind of chilly outside.
Yeah.
And I remember, because I get up really early in the morning being a currency guy. I remember being at like 6 o'clock in the morning. It was like 6 or 6:30. Sun was just coming up, very desolate outside of our office. I was looking around, bunch of, it's the typically like our offices would be empty, like, parking lot wise. I remember looking around and it was like a sunny day and the S&P was trading probably around 690 or something. It was a couple of days from the bottom, like literally a couple of days
March
from
of 2009.
Okay, is it 2009 from the Haynes bottom? And I remember walking outside. I lit a cigarette, and I was like, "The world's gonna come to an end soon." I remember vividly saying that.
Yeah.
And then I went inside, slapped myself in the face. I'm like, dude, I actually just put everything I had into my retirement account at that moment. That is actually what I did. And then I rode the S&P up to 1100 and I thought I was king shit. And
well, that's a good trade.
Anyway, regardless, I remember that feeling so vividly. And it's scary. It's not fun.
Well, here's my little story. There's a financial advisor who has been a subscriber of mine since about 2010. And what he's told me is he spent 150 hours after the financial crisis looking for people who both called the top in 2007, the decline, but then turned bullish in 2009. He found 3 people: Jeff Gunlock, Ned Davis, which is a big research firm,
of course,
and Jim Welch. And so Jim Welch. So
never heard of him.
There were signs before that decline took place. And there will be signs when we make this very significant top and start to roll over. There will be signs. I just don't see that they're here yet.
Yeah.
But at the same time, I'm cognizant that I'm going to be looking for those signs because it's going to be really important. And historically, the sky is falling at the bottom, and we're going to the moon, Alice, at the top. And contrary opinion, which is kind of what you're referencing, Blake, is way more important than if you listen to CNBC and I'm sure Bloomberg, they talk about the market discounts the future. Okay. And in October 2007, the S&P made a new all-time high. What was this discounting? In March of 2009, your personal experience, the S&P has been going down. It's down over 56%. Oh my God. What was it discounting? The end of the world? So my point is the concept that markets discount the future, that's right about 60% of the time when you're in the middle of moves. The economy's in decent shape, earnings are growing. Conversely, gee, things are unraveling, it's getting worse. But at important tops and bottoms, the idea of the market discounting the future is always wrong. And yet it's gospel on places like CNBC and I'm sure Bloomberg. as opposed to contrary opinion.
Yeah,
So,
it is. And by the way, bear markets don't sell, just so you guys know. They don't. They
no,
sell for people that are selling their newsletter or whatever. That's just
right.
you guys are here. Bears will they just.
Yeah,
I mean,
yeah,
you can see them on the YouTube doom loops.
yeah.
They're selling their subscriptions all along because they just talk. And bears always have a great story, and they have a great story. But you look at the markets, critically through the lens of the charts, and you take into account everything all the information we have. And when things change, you have to be good enough to recognize when those changes come. And Jim,
Right.
I think you are one of those three people. By the way, your last name is Welsh, right?
It still is.
All right. All right. Well, Jim, let's get into some of these
Okay.
charts really quick, because maybe you might get us into.
We'll go quickly because I've got a lot of charts. But
Yeah. I mean, you got a lot
basic
of charts.
stuff.
We did a lot of talking. So,
Yeah, we did.
all right.
Okay. So again, we try to combine fundamental analysis and technical analysis because to me, at important turning points, you need that cohesion where they're both kind of providing the same message. That was the case in 2007. In December of 2007, Blake, I was saying there's going to be a recession in 2008. Housing prices are going to drop by 20%. People thought I was nuts. Okay. So I just wanted to provide perspective. The unemployment, the jobs report was soft. I think people have gone a little too far in terms of, oh my God, the labor market's going to hell. This is perspective. If you go back to 1948, the average unemployment rate through both good times and bad is 5.7%. So if you want to know, hey, do we have slack in the economy or is it tight? I just basically said, let's do a band. What's 20% above 5.7? What's 20% below 5.7? You get 456. The unemployment rate this last month was 4.1. So if you're sitting on the Fed, are you going to believe that the labor market is tight? And the answer is yes.
Yeah.
And so to me, this was just to provide perspective. Plus, over the last 6-8 months, it's declined from 4.5 to 4.1. So even the near-term trend, and we can debate about the participation rate and the impact of immigration that's been happening in terms of removing bodies from the labor market and so forth. But just from a historical perspective, this just shows us that, overall, the labor market is tight. And it also explains why the economy continues to be okay. There's people, I did an interview and, the comments were like, oh my God, this guy's an idiot. The economy is shit and all that. And the point I try to make is that for the bottom 20 or 30% of wage earners, it is hard because their wages haven't kept up with the cost of living. But the top 10% represent almost 50% of spending. So the pressure on that bottom third, they represent maybe 10% of consumer spending in total. So yeah, is it tough? Absolutely. But do they make or break the economy? No. And I think that's one of the things that has kind of colored people's vision about the economy, Blake, is if you're in that or people are in that bottom 30% struggling, that in a sense creates your whole worldview. And all I'm
Yeah.
trying to say is you got to look at it from a top-down perspective of why the economy is still doing okay, and the low unemployment rate is one of those reasons.
Now, you talk about jobs needed here.
Yes.
So what is this chart representing to you?
Okay. Well, on the left-hand side, we can see 3-month job growth. The last 3 months, including the 23,000 decline we saw for July, is about 20,000. All right. And clearly, the number, if you look at the last 4 or 5 bars, has it been softening? Yes. All right. That 30,000 needed. What the Fed has estimated, and other private economists as well, Blake, is we're at that kind of a weird place that we almost have never been before in history. The number of people wanting to enter the labor market is very low. Therefore, you don't have to create a lot of jobs to allow the people who want to get a job to enter. And that number is around 30,000. For decades, it was probably 150,000 or more because you had so many people, people had babies 18 years later. Hey, I want to get a job. 22 years later, I want to get a job. Well, that has changed dramatically. I mean, since 2007, the birth rate is, I don't want to say collapsed, it's down significantly. So my point is, mentally, we're all been conditioned that, boy, you better have 100,000 jobs or more to reflect a healthy labor market. And this is like a major reset. Maybe you only need 30,000 jobs to kind of have the labor market in balance. Through that lens, the 20,000 average the last 3 months does not look dire. It doesn't look like the labor market's falling apart. The right-hand side shows revisions. And you can see how revisions have shaved off. I think in the last 2 months was about 100,000 jobs. So we're seeing a softening in the labor market. I just think potentially people, um, you know, overreacted to, oh my God, a loss of 23,000. Plus,
Yeah.
I'll note that there was a decline of 50,000 government jobs related to education. Now, during the summertime, that seasonal adjustment for education can get funky. And leisure dropped 40,000 jobs. So there were some data points in there, Blake, that even cast some doubt about, well, how legitimate was that minus 23,000? But from a bigger picture standpoint, is the labor market softening a little bit? Yes. Is it problematic? No, I don't believe so. And for the FOMC members who are more worried about inflation, I don't think that jobs report is going to make them think, oh my God, I got to shift and I'll worry more about the labor market. I don't think that's the case.
Right. And that's what, and Chris Pulver was just saying that that's, the 20,000, jobs per month is a break even for the labor market. And yeah, I mean, you're going to have a little bit of volatility and, some people might even chalk that up to the World Cup being over too.
In
So
terms of the ending of that's what I wrote on
yeah,
Monday. That
yeah.
that probably played a role in the 20,000 or the 40,000 decline in leisure and hospitality.
Sure. So let's talk about the CPI now, Jim,
Yep.
because CPI different situation
Yeah.
that moved the needle this week. It didn't really move the needle a whole lot. We saw the dollar kind of jostle around a little bit. I think that was more
Yeah.
positioning than anything. But how are you reading the CPI?
Well, the numbers came in as expected. As I wrote Monday, my thought we'll see about a 0.2% increase. Of course, last month it was minus 0.4 because of the big drop we saw in energy. I'm not sure some of the rebound that we saw during the month of August, or pardon me, July, has bled through completely, Blake, because I think gas prices were up 7% in the month of July, and crude was up, I don't know, 25% or something. But nonetheless, if you just look at the flat line of the core, in January, it was 2.5. So it went up to 2.9 in May. And when we were talking back in May, I was like, Blake, we're going to see it come down in the next few months. And we went through the discussion of why, and it has. I think you can see a little bit more softening in the next couple months as well. But from the Fed's perspective, after 63 or 4 months above 2%, are the hawks going to say, oh, okay, now I don't have to worry about inflation? I don't think so. A number of them have said, I really need to see signs that we're really working our way down to 2.5. I'm not sure this does it. And the last thing I got to say, and it's important, everyone's just, well, no, the percentage of the hike is this, and oh no, after this data, it's that. The reality is most of those people have not made up their mind. We're at a point where we're going to get another employment report, another CPI. We get a PCE report, I think, tomorrow. And I think there's enough people sitting on the fence, Blake, is that I don't have to make up my mind today. We're going to get more data, and I'm going to want to see that data. So all this jockeying in terms of will they, raise in September or not, and the percentage is jumping around, it's noise. The people who are actually going to make the decision haven't made their decision yet. So
Yeah. All right. Well, yields have been stubbornly strong, and we've seen them bounce even after the jobs report last week. They came in a little worse than expected. I think the market actually, after the knee-jerk reaction, realized that wasn't really that bad.
right,
Although
right.
some people were making it out to be bad, as you pointed out.
Yep.
Yields bounce back. And the 10-year yield still looks pretty constructive here. What are your thoughts technically?
Well, the thought I had was that we could see the 10-year get down near 451 was the number I used last week, 455 this week. Why? Because you saw about a 15 basis point decline from 4747 to the 4603. Well, what's 15 basis points from 470, 455? So this looks like potentially you could see yields come down a bit more in the next handful of days. I continue to believe that the trend is up. One of the things is the amount of paper. In the month of July, The monthly deficit was over $400 billion. The annual deficit, according to the CBO, Congressional Budget Office, which calculates this stuff, for this year, ending in September, is 2.1 trillion. So this is, again, one of the reasons why the economy is holding up. Well, the government's running a 6% annual deficit. That's a lot of spending flowing into the economy. So I still believe the trend is up and that we're going to work our way to 5% in coming months.
All right. Well, let's take a look at gold because gold has had a nice rally from the lows.
Yep.
Point out the triangle last week. It's continued to extend, and the pullbacks have been very minor now. So I know what you're going to say just because I meet with you every week. But is that the low? Was that the low?
Well, over the next 12 months, I don't believe so. Again, my belief has been is that the decline from 55.95 to 39.45 was the first part of a larger wave for correction. In other words, you had this enormous move from 16.16 to 55.95 from September of 22 to January of this year. I think that to correct that move, the magnitude of it, you're going to need time and price erosion. So when we got down to the 4,000 level, and by the way, in January I was talking 4,100 that we could see, and then over the last month or so, I'm like, you know what? I think we're in the process of forming a bottom, which is why I recommended gold under 4,000, under 39.60 to be exact, in anticipation that we're going to see a B wave rally. So we had the A of 4, we're in B of 4, and I think potentially we're nearing the end of the first part of that B wave, which is why on Monday I suggested that Tuesday morning it was time to sell half of the gold position. So the average cost basis on the going in was 4,063, and in the first 15 minutes of trading Tuesday morning, gold fluctuated between, I think it was 43.93 and 44.03. So I picked the 44.98 as being okay, an average of where people are going to. I think we're going to see a pullback, and you could see that pullback down towards 4,200. Then my expectation, Blake, is we're going to see another leg higher that would take gold potentially up to 4,700. And all that is a retracement of the $1,600 move we saw from 55.95 to 39.45. So to answer your question, when this B wave is over, I think gold's going below 4,000.
See, Jim, you know what it is? My week ahead video that I did last Friday, I was like, if gold dips to 4,200, I want to be long. And that was like one of my trades of the week. See, my head, my thinking's just ahead of yours. That's it. That's why it didn't happen this week.
And I'm used to it, man. You know.
Oh man, no,
at least I'm reaffirming your guidance, right?
Yes,
It's not the worst thing in the world.
No, I think it's great. I'm like, I've been wanting to buy gold at 4,200 all week. It's just,
well, and look at the RSI.
Maybe it's going to get there next week.
Look at the RSI. So one of the things I was pointing out is gold kept kind of a falling wedge. The RSI kept making higher lows. Well, now the RSI is up to 70. Well, that's why to me it's time to at least take some money off the table, and let's see how much of a pullback we get. But I'm with you. I think on this drop that I think is coming, I want to look to be a buyer and build that position back up.
All right, very good. All right, let's continue on, Jim. Let's talk about gold stocks. So GDX. So what are you doing here?
We don't talk about this, but every week in my weekly technical review, when I talk about gold, I talk about the gold stocks. Yeah. And the same story is that as GDX was making a lower low below 69, look at the bottom panel, the RSI. It was making a higher low. Same kind of a falling wedge in GDX. So, my take was it's time to buy it and then add to it above 77.99. And the reason is GDX as well as gold kept making lower highs and lower lows. That's the definition of a downtrend. Then gold got to 41.66, GDX got to 77.90, and they both had made higher lows. So taking out those prior highs, broke that pattern. And so anyway, you can see that blue trend line connects the lows that have taken place over the last 6 or 9 months. So going back to that trend line is a natural level of resistance, that you're going to the underside of it. We had one day above it, I think it was yesterday. The RSI on GDX got above 70 modestly. And so again, to me, this was a place to sell half of the position, which, and I sent out a special report on Monday, an hour and 15 minutes before the close, to tell people, hey, it's time to sell half of the GDX position. And, that's the average out price is 90.43. At the same time, I'm thinking that we get a pullback here. I'm looking to go back in because I think if gold makes that move to 45 to 4,700, GDX is going to make a run to 102. And there's an outside chance it making a new all-time high. Once the gold stocks go, they go. I mean, look at in just what, 3 weeks, it went from under 69 to 92,
Yeah.
$23, like,
It's a hell of a move.
35% in
Yeah.
a few weeks. So if you get something similar, you pull back to, let's say, 81, 82-ish. There's a gap, I think, at 80.18. And then you add, 30, $23, you're above the 102. So that's my longer term outlook. Just short term, I thought we're set up for a pullback.
All right, interesting. We had a Tracy Schuchart on yesterday, and she was looking for a similar type of move in gold as well. And she was talking about the miners the last couple of weeks. So very interesting that both of you are really confirming the same thing.
Yeah.
S&P.
Great minds running in a small circle.
That's right. Right. All right.
All
So
right.
the S&P, well, this is where you and I might differ a little bit. I still think there's some upside in the S&P. I
Yeah.
look at the markets here, and I see this, nice little pennant and consolidation and, breakout. I still think we got further to go, but you look like you might be, this might be it for you.
Yeah. Yeah. As we talked at, the outset, from the high at 76.20, that looks like, A, B, C, D, E down to the 73.14. And if you look at a chart, this chart doesn't cover it, but going back to the March low, you can kind of see 1, 2, wave 3 ending at 76.20. Then this triangle formed, which is classic wave 4 behavior. And then you're supposed to get a thrust. Well, we've gotten a thrust. As I noted earlier, the breadth underneath that thrust has not been very impressive at all. And so for me, the rally from 73.14, you can see 1 up, 2 down. Wave 3 was the 77.93, which is why on Monday I think we're going to get another pop above 77.93 to complete this move. Now, is this wave 1 of a larger rally? In other words, we'll get a wave 2 pullback, and then we're going to motor up to 8,200 or whatever the number is. That's certainly possible. But just looking at the chart pattern that I see, and what led me to believe that we were going to see a rally above 76.20 was the triangle. So the next handful of days are going to be, kind of important to see, okay, is it just a very shallow pullback, holding comfortably above 76.20, pull back to 76.50 or something, and then, another leg higher? That is possible. I'm just in the camp that I think this is a place to take money off the chips. And if you want to be a wild and crazy guy, taking out a small short position is warranted. And then we'll see just what degree of weakness shows up.
Well, you bring up a really interesting chart. You're going to bring up the Mag 7, which hasn't done crap for a while. And so
Right.
that's why I'm asking, why are you going to bring up this chart? Because Mag 7,
Yeah.
and I'll just say, eyeballing it, that is what we call a Gartley pattern, which it's signaling a reversal. But are you seeing it the same way? Not a Gartley necessarily. I know harmonics is everything, but are you seeing a reversal here?
Yeah, I'm showing this because I've been covering it the last couple of months in my letter.
Okay.
And because Mag 7 are obviously very important. The weighting in the S&P is huge relative to the other 493 stocks. And in late June, I noted you've got 5 waves down from the high at 71.16 or whatever that number is. So to me, what that implied was A, you've completed something, 5 waves down. It suggests that you're going to get an intervening rebound to retrace that decline, some percentage of it. But that 5 down then means after whatever bounce we get, there's another leg down coming. And so I was looking for it to rally from the 61 level up to 67. It got to a little over 69. And then as we were bottoming in July 29th, you can see, uh, it bottomed. And I thought if the S&P, Blake, was going to get above 7620 and make that move up towards 7,800, you needed the Mag 7 to rally and you needed the semiconductor stocks to rally. So this looks like an ABC up. And I think it opens the door for this to roll over and decline below 60.72. So my idea of, gee, the S&P is setting up for a pullback of some magnitude. One of the factors that supports that outlook is this chart pattern in the Mag 7 stocks. They look ripe for a deeper pullback.
Got it. All right. Well, let's take a look at the semiconductors. You talked about the stock market's going to top when semiconductors top. Now, semiconductors obviously have topped, but the stock market continues to grind out new highs. So,
Right.
how are you seeing it here?
Yeah, well, and back in June when we were talking, I said I think the SOX semi SMH is going to drop to 527. And then as we got closer, I said, you know what? I think it'll hit that blue trend line, which was around 515. And you had a spike down just below it by a little bit. My belief was that we would see SMH, and what I wrote about a couple of weeks ago is a rally to 592. We got there today. Can it go a little bit higher? Of course it can. But same idea that we've had this pullback, things got oversold, we got an oversold bounce. I think that bounce is going to be followed by another decline where the semiconductor index will drop below the 503 low. If that happens, again, that will be supportive of a deeper pullback in the S&P. If you have both the Mag 7 and these stocks declining, just as it kind of kept the S&P from, moving up aggressively during June and July. All we did is go sideways because you had those stocks pulling us down while other sectors were moving higher. To me, these are all the little pieces that have led me to the conclusion that I think we're near, a high, at least a short-term high, and potentially a more intermediate high in the S&P.
But Jim, but couldn't we get just massive rotation and General Electric become the biggest company in the world once again?
Come
on.
And then Cisco will be right behind it.
Yeah, you saw Cisco's. I don't know if you were here when I was talking about it at the very beginning. We just hit the ABCD. Well, we did it a couple months ago of the whole .com sell-off. So it's like maybe Cisco is the next Nvidia. You never know, Jim. You never know. Okay, the next chart, or the second to last chart you brought, is the dollar. You've been very constructive on the dollar since January. I actually just saw analysis from an analyst over at one of the big FX shops. He's like, this is an inverted head and shoulder pattern. The dollar is going to rally from here. I mean, this is pretty important support, I would think.
Yeah, it is. It is for obvious reasons. When we got up to the 101.80, I thought we'd have a pullback, and the pullback has transpired. A, B, C. Well, the C wave should have 5 legs, and if we were looking at a 60-minute chart, you could see it. 1, 2, 3, 4, 5. Last week, I said, okay, if you get below 99.42, it's a buy, and it traded to 99.40. This choppy pattern that we've seen in the last 6, 7 trading days, there could be one more dip down. Can't rule it out. I think if you get above the 100.35, that would, to me, be somewhat conclusive that the low is in and the dollar's trading above 101.80, or it's on its way to do that.
Yeah.
So, again, we've had, a shift in perception that the Fed won't hike in September. I'm not in that camp. I think there's still reasonably high, more than 50-50 that they will hike in September. and obviously if the pendulum starts to swing back and treasury yields start to move higher, those are tailwinds for the dollar. So, and the economy, I think the Atlanta Fed's GDP now is like above 5% for the second quarter, pardon me, for the third quarter. Now that's a real premature number and so forth. But again, it just shows that the economy seems to be doing just fine. Thank you.
Yeah.
So,
Yeah, it does feel that way. And I would also agree that this is pretty key support. Now, you
yeah,
did bring a chart of crude. I don't know why, because it ain't doing anything. But if you must do analysis on crude, we're gonna gladly oblige.
you're going to indulge me. Well, thank you very much. All right.
Yes.
So, I, expected a rally up, and we got a little higher than I thought at the 93.50, I think it is, or whatever. I thought we'd have a pullback. The pullback is ABC. And the key level to me, Blake, was closing below 75 even. It got to 74.20 something or 74.50 intraday, but it closed at
23, yeah.
75. Yeah, it closed at 75.23 that day, and it's been up ever since. So that three-wave pattern to me implies that we're going to get a lift above 85.57. It also opens the door to that from the rally from 67 to 93 is the first part of a bigger move higher. So what's 26 to 74? That's 100. So I think there's a shot, again, as long as it doesn't close below 75. And if we start to see more strength, we'll be able to raise that break-even level, if you will, or make or break level. But I think oil is going to move above 85.57 and potentially above that 93.50.
Well, Jim, I think you could probably agree, and I think most of the market probably looks at it this way too, is that that it doesn't seem like there's going to be any resolution with the U.S. and Iran. I mean, the comments yesterday from President Trump was, well, I guess we're just going to, we control the Strait of Hormuz. I guess we're going to keep it. That meant to me yesterday, like he's done negotiating on this opening the strait. He could care less now,
Yeah,
based on
yeah.
that comment alone. And as you know, this tussle is going to continue, and it's probably going to continue well into the midterms and beyond. So I don't see
Well, I
why
think
crude
that's
oil should go down.
yeah, and I think that's Iran's strategy is that we'll rope a dope, which is the analogy I've been using, that because they believe that the longer it lasts, the stalemate, and you get closer to the midterms, that Trump will cave in. It's certainly possible. They think they're winning. That's the bottom line, but they think they're winning. And in Monday's weekly technical review, I listed the 8 or 10, demands that they have, and they're ridiculous. So I think again, you have the hardliners in Iran that really I think are running the show, and I don't see how they're going to give up the ship, so to speak. And so
Yeah.
yes, I think this continues, and I think more oil is probably coming out of there than maybe we know, but at the same time, there's a huge shortage that's been developing relative to the last 4 or 5 months. And I think somewhere along the line, upward pressure on oil and things like diesel is already happening. So anyway, bottom line is the chart pattern, just as I look at it, says, you know what, near term, I think we're going to see higher prices. What causes that? We can all make guesses, but
Yeah.
that's what the chart pattern looks like.
All right. Well, Jim, I appreciate you going through these chart patterns with us and all the macro views. Guys, if you don't follow Jim, obviously he is at Jim Welsh Macro on X. But more importantly, send him an email so he can send you the most recent technical review. Jim, what is your email that they can send you?
Jim Welsh Macro at Gmail.
Jim Welsh Macro at Gmail. That's good. And make sure you let him know that you saw him here on the Trading Analytics Show, Lunch Money, Trader Summit, wherever you saw Jim. Let him know, because if you decide to stick around, he'll say you're a friend and give you a healthy discount. So
that is correct.
all right. Well, Jim, appreciate you being here as always. I love you just keeping us all on track. We're bullish until we're not. There's the warning signs are out there, but we got to continue to take it day by day, especially in these long summer trading days that we have. So
Yeah, was it Dogs of Summer or something, or I don't
the
know.
dog days of summer are upon
That's it.
us.
Yes.
They are.
But I refuse to bark to respond to that comment. All right. Hey, well, have a great week, and thanks for tuning in, all of you folks, and spread the word, because I think
All
we're
right.
doing some good analysis here. Thank you.
Absolutely. Thank you all. And thanks, Mr. Weissman, Cooper, and everybody else listening in. You guys have a great one. We'll catch you next Thursday, but I'll see you tomorrow on the Lunch Money Show with Chris Pulver. All right. See you guys.